Yes, madam.
Okay. So, hope you have no questions last week, not last week, yesterday's lecture. Theory of markets we discussed. We divided markets into two components. Did you remember? So, theory of cost, I'll continue again. Theory of markets, we have divided markets into two, perfect and imperfect markets. Okay, perfect markets, we learned the characteristics, many sellers, many buyers, free entry, free exit, this type of characteristics. And imperfect competition, imperfect firms, we discussed about monopoly, monopolistic, oligopoly, duopoly, like this company, these firms. Okay, with some examples. So I hope you got all points clear. Or any questions? Because since your exam is coming soon, I hope you all can study well. If you can understand in the lecture itself. Okay. So today I'll do this section and I hope to finish your applications and all tomorrow. We can take hopefully 6 hours for 4 hours, 6 to 10, and I hope to finish your sections. Is it okay? Hashani, any problems?
No, madam.
Okay, so hope you all understood well. Okay, if so, let me to share today's section. Hope you all can see the screen. Is it clear to you, the screen? Okay, so I just change the color of the slides just to make you understand, because yesterday somewhat complex slides I changed into a simple one, just for make you to understand clearly, because since you are learning these cost components for the first time. Okay, so at this section you will be able to understand the theory of cost. So under that, total cost, average cost, marginal cost, fixed and variable cost component. So with the theory, I hope to do very small calculations to make you understand basically what are the basic cost components and what is the total cost, what is the average cost, and what is the marginal cost. Okay, so then I hope to explain you economics of scale. Then after learning this section, you all will able to explain what is economics of scale. Okay, then you should be understand production choices and costs in long run and short run. Okay, so we'll briefly do these and you should be able to explain ISO cost curves. Okay, so here actually the section is theory of production and cost. So at the beginning, I hope you all remember we discussed about the production curve, total production, average production, and marginal production, stages of production with the marginal product and average product curves. Okay, so these all I think you all remember. Okay, now let us study the theory of cost. Okay, so here actually we need to learn what are the types of costs and how it varies. Okay, so here the theory of cost definition states that normally I'm not asking definitions, but theory of cost says the cost of a business highly determine its supply and spending. So what are the all spendings in a particular business? That is the cost. Okay, so in the modern theory of cost in economics looks into the concepts of costs, especially short run and long run, and they are studying with the economies of scale. Okay, so now we will see what are costs. Okay, so normally the market value of the inputs a farm uses in production, because market value for each and every item, let's say fertilizer, insecticides, pesticides. So we have the market value in terms of rupees price. Okay, for seeds, for example. So these all the value of inputs is called as the value is the cost. Okay, so normally the firm uses different inputs in the production process. So if any other producer uses different inputs such as seeds, fertilizer, pesticides, insecticides, or any input, it incurs a cost. Okay, there are no free inputs. So that's why the producer has to take these inputs for his production. So that's why simply we can say the market value of the inputs a firm uses in production process. Okay. So in that costs, because costs attached with revenue always. Okay. So the revenue means the total amount a firm receives for the sales of its output. So the production process cost incurred. In the selling process, revenue incurs. That means revenue is associated with the selling process. And cost is associated with the production process. But in the selling process also, advertising and all cost components also there. Okay. But mainly we are discussing here with the total how cost relates with the total revenue. Okay, so with the initiation of the section, I'll give you very small calculation just to see whether you know the basic concepts of total revenue and total cost. Okay, so you know profit gains from total revenue minus total cost. Okay, so now briefly see, if ice cream production cost is 10 rupees and selling price is 25 rupees and sold 2000 ice creams, that means produced 2000 ice creams and sold the same, what may be the profit? Very simple calculation. Just try. Ice cream takes 10 rupees to make, means the production cost per ice cream is 10. The selling price is 25 and selling quantity is 2000. What may be the profit? Yes, one answer very quickly. Very good. Ravindu, very good. Others answers? Ravindu is a very good mathematician, isn't it? What happened to others? 30 students are there. Other students didn't get the point. Yes. Hashani also gave the correct answer. How about others? At least one more student's answer. Because when you heard the profit, It contains revenue and yes, Vimandya also very good. So Ashani, Vimandya and Ravindu gave answers correctly. So see the calculation. So it's very easy because each ice cream takes 10 rupees and producing 2000 and selling 2000. That means any question? Any problem? Okay, maybe by mistake. Okay. So profit means the revenue minus cost. So the revenue is the price is 25 rupees and selling quantity is 2000. I think this is clear. It should be the cost should be reduced from the revenue to take the profit. Okay, so the cost is production cost is 10 rupees per unit, but here we have 2000 units. Okay, then you can easily understand the total cost. 50,000 is the revenue, cost is 20,000, then the profit is 30,000. Okay, maybe again I can ask another way the question. The sold quantity is 2000, but production quantity may be vary, another one. So if so, in that case, normally we give all information accordingly. Okay, hope you all understood this very small calculation with total cost and the revenue. Isn't it? Any problems from anybody? Okay, silence makes no problem. Okay, now we'll see briefly what are the types of costs. Okay, so you may have heard, now you have learned opportunity cost. What's the another name for opportunity cost? Foregone cost. Okay, so we'll take the previous example and we can see the producer made this much profit. That means 30,000 profit in making ice cream. So in that case, please assume he was an amazing programmer. Okay, and he, okay, to mistake here, he could earn 80,000 a month by programming. If so, what is the opportunity cost? So 80,000 is he would earn from this programming as a programmer. But 30,000 he is getting from selling the ice cream. So his foregone cost is how much? 50,000. Okay. So, sorry. Yes, very good. Ravind calculated very quickly. Okay, very good. So these are the basic things you should know in these cases. Okay. So, which means she is losing 50,000 by making ice cream. She would have earned 80,000. We have a quiz on Thursday. So can we schedule the lectures on Thursday night? So we have to prepare together. I'm not getting. Thursday means, no, tomorrow I can finish Hiruni. Is it okay? Hiruni? Hello?
Yes, madam. Tomorrow lectures.
Without doing tomorrow. Okay. Okay, it's okay. Without doing tomorrow, you are requesting to do Thursday. Okay. If Allah okay, I can do this one. Okay. Please remember, without doing tomorrow's 6 to 10, we'll do Thursday 6 to 10 and finish all. Is it okay?
Okay, madam. Thank you.
Okay, you're welcome. So, I think you all can understand this concept, the opportunity cost concept. So, the foregone cost. That means losing this much 50,000 by making ice cream, because she would have or he would have earned 80,000 if he would have done programming. Okay, so this is the opportunity cost or economic cost. Now we'll see explicit cost. Okay, so variable and fixed cost are coming later on because they are very common costs. So another type of cost is called as explicit cost. So explicit cost is the clearly stated costs. That means direct cost. For example, employee wages, input costs, rental charges, or other transport charges attached with the production or advertisement charges. Okay, so anything are called as explicit costs. So these are the costs which are stated on business balance sheet. In the balance sheet also, these all are mentioning what are the explicit costs attached with the business. Okay. When we go for the implicit costs, it says these are also the cost components, but they are not seen. For example, you can see a factory may close down for a day in order for its machines to be serviced. Okay, so the factory will close because the machines to be serviced. So the explicit cost to repair machines is here in dollars, $10,000. However, explicit means direct cost. Okay. But however, the factory has lost a whole day output, which has cost its $50,000. Okay. So that indirect cost is known as the implicit cost. So directly that cost is not showing, but it is there. Okay. Sometimes the cost incurred, let's say you are waiting in the bus, or you are waiting for the bus, or you are waiting for a class or something. So that time we can value, but it is not directly showing. Okay. So that is the implicit cost. Okay, another example, let's say one person is smoking, like externalities. Okay, so you are nearby and you are getting that bad smell. Okay, then you got that bad gas inside your body, and you may get any respiratory attack. So in such cases, you have to give some medicines or something to give to recover from the disease. That is indirect cost you have to bear due to that smoke. Okay, so these costs, these external costs also, the externalities we call them as in the marketing literature. These this cost also we can call as implicit cost, because we have to bear the cost, but it is not prominent. It is not clearly seen, like explicit cost. If we pay for employees, if we pay for fertilizer, if we pay for seeds, our built-in rental charges. So it's just clearly seen. Okay, directly we pay these things, explicit. But implicit, you can see some indirect cost occurs. So we can't measure it directly. Okay, so here also loss of this production value is the cost. Okay, so I think you clearly understood the difference between explicit cost and implicit cost. Though it gives two nice names, the meaning is different. Any questions? Hope you understood well the two costs, differences between these two costs. Any questions? Hello?
No, madam.
Okay, great. If you have any problems, please ask. Okay, don't be shy. Now, explicit and implicit costs. Briefly, we'll see explicit costs, costs that require in spending money by the firm. But implicit costs, costs that do not require directly spending of money by the firm. So that is the very good point. So when we say the accounting profit, normally we calculate accounting profit. So we are taking total revenue minus all explicit cost. That's why here profit calculations, you got this one. See, revenue minus cost. But here we have to consider that indirect costs as well if we calculate the economic profit. That is the difference between accounting or normal profit, what we are calculating, and the economic profit. Economic point of view, we need to consider the indirect cost as well. Okay? So implicit as well as explicit cost. So implicit cost is not considering because this is indirect cost in the normal profit calculations. But in economic profit calculations, you need to understand what are the implicit cost components, and it should be added with explicit costs. Then you can get the economic profit after reducing from the total revenue. Because revenue is not real revenue if we are not considering indirect costs as well. Okay, hope you understood the concept. If not, please put the message. I'll explain again. So here in graph also you can see the situation. So in the economic profit, here one problem, two axes are not labeling, no units, okay, because I just got this from the internet, but you have to remember every time we have to write the units as well in columns, axes, okay. So here normally in the economic profit we consider implicit cost as well. The total revenue is there. In the accounting profit, we consider explicit cost. Okay. So that's why here we can get higher profit because we are not considering implicit cost here. Okay. But if we consider implicit cost as well, the economic profit comes, it is less than the accounting profit. Got the point? If no cost means total revenue equals to the profit. Let's say 30 rupees. Okay, but if cost comes, revenue should be reduced. Then if we consider only the explicit cost, 10 rupees, the profit comes as 20. Total revenue minus explicit cost. But here, if we consider implicit cost as well, you have to reduce both costs, explicit plus implicit from total revenue, 30. Then your profit is 10 only. Okay, real profit is actually 10. But direct profit, if we consider direct costs only, it is 20. Understood this diagram? It says many things. Hope it's clear for you all. So now another cost components is fixed cost. Okay, so fixed cost means it will not vary with outputs. That's very important. Okay, that's why they are called as fixed costs. They are fixed expenditure of the company. For example, let's say the building rent of the company. The company is building rent. Whether the production is low, whether the production is high, whether there is no production at all, the rent should be paid. Okay, then taxes also should be paid accordingly with or without having any production. So interests, everything you have to pay. Okay, let's say if company has any insurance, that also they have to pay. Okay, so these are the fixed cost components. That is, these are the constant one, fixed one. So in other words, we can say these are the costs that remain same irrespective or regardless of the number of units that are being produced. Okay, so that will not change with the volume of the production, size of the production. Whether our production, whatsoever the production, we have to pay the cost. Okay, so these are the examples. No matter how much the business sells, these fixed costs are the expenses. Okay, so these are regular costs of business must pay, and they are not affected by how much the business produces. Okay, so these are the common fixed costs: rental charges, salaries, insurance, equipment, lease payments. Okay, sometimes leasing arrangement they are giving, taking equipments, some machineries. So they have to pay whether they are getting production or not. Sometimes they are car, they leased out and they have to pay this amount. And utility payments. Sometimes companies have to pay some payments. So these are also fixed for companies without having a production, even though they are not having any production. Okay, so that's why fixed cost in the normal graph, fixed cost is fixed forever. Okay, so normally when we calculate the total fixed cost, so you need to determine organization's total fixed cost while adding all cost together. Very simple. Okay, so total fixed cost are the sum of all individual fixed cost. Okay, so because the total cost comes from the total fixed cost plus total variable cost, so you can take this equation as well. But afterwards, I think you can be this can be more clear because total production costs comes later on. Okay, so we'll see variable cost as well before going to total production cost. Okay, so the variable cost are the costs vary with the output. See the difference between fixed cost and variable cost. Fixed cost is fixed with the production, but variable costs may vary with the production, size of the production. Okay, so that's why every time we have to consider the difference between these cost components as well. Okay, so for example, you know variable costs are salaries for the employees, raw material costs. So then you can combine, see implicit and explicit costs as well. Okay, so explicit cost that requires spending of money by the firm. So these variable cost components and fixed cost components, these are explicit cost components. They have to pay directly. Okay, but implicit cost components means costs that do not require direct spending of money besides pay. Okay, so that's why you can remember under some costs they are falling another categories as well. Okay, so variable cost means cost per unit multiplied by number of units. Let's say one labor's charge is 2,000 per day. Then if there are 10 laborers working in the field, then the total variable cost is 20,000. So likewise, you can calculate the variable cost simply. Okay, so variable cost is the cost that changes, maybe increases or decreases. That's also very important. Changes means it can be increased or it can be decreased based on the number of goods produced by a company or the service requirements of customers. Okay, so these are the different types of cost, variable costs. I think you know material costs, labor workforce, associated charges with labor, fees, commissions, transportation cost, their salaries, okay, fuel charges. So vary with the production. So you can take this on. Now we'll do very small calculation. Let us assume that a company that manufacture 900 linen shirts daily per day. To achieve this, the company appoints 45 laborers and pays each labor $18 for a day's work. Calculate the variable cost for 30 days. Read the question very carefully. And now I'll give you 10 minutes, but I need many students answer. Okay. So please give the answer now. Read the question very carefully first. Okay. I'll give you 10 minutes because all answers, at least now 31 students are there. At least 10 or 15 students should answer, should do the calculation by themselves. Okay. Very simple one. Still no answer. Hmm? Remember, days work charges are given. You have to calculate the variable cost for 30 days. Yes, one answer came from Hemachandra. We'll see whether it's correct or wrong. Very good. First try. Yes, Ravind also gave the answer. We'll see whether it's correct. Both of them got the same answer. Maybe it is correct. Hope that you are not sitting together. Okay. Hemachandra and Ravindu. Another answers, please try others. Very good. Bandara also gave answer, but somewhat different answer from previous two, but we'll see. Okay. Very good. Kavindu, another answer. Anyway, very good. You tried. Others also please give. Then you can understand where the problem is. Okay, Hemachandra again change the answer. We'll see. Recalculation is also very good just to get an idea. Okay, try first. No any further answers, I guess. Huh? What happened? 31 students. I got 1, 2. Another answer came. Yes, Vimandya. Very good. Now Vimandya, Hemachandra, Kavindu, Bandara, Ravindu were given answers. Huh? Okay, please teach others. Ravindu, yes. Ravindu also again changed the answer. Now hope the answer is correct. Many of you have given the answer. Bandara, please check again your answer. Okay, we'll see the answer. Yes, many of you got the answer. Here, I think that answer firstly got by Kavindu, isn't it? Yes. Kavindu, very good. You gave the answer first. And others also, anyway, Hemachandra, Vimandya, Ravindu.
Excuse me, madam.
Yes, yes. Tell me, please.
Madam, එතකොට ෂර්ට් යුනිට්ස් ගානින් වැඩි කරන්න ඕනේ නැද්ද ඔය
නෑ නේද? ඒක තමයි මම ඔතනට ඔකට වරදින්න දුන්නේ. මොකද variable cost means just the cost component. See, let us assume that a company that manufactures 900 linen shirts daily, to achieve this, the company appoints 45 laborers and pays each laborer this much. Okay, but we have to give labor charges only for 30 days. Whatsoever the production, the variable cost means all cost incurred in the production process. Got it? Hello? So that's
yes, madam.
Yeah, that's why it's very, very important, very good question. Because here, whatsoever the production, it doesn't matter. Okay, so even though they can produce 930 for 30 days, they have to pay for labor charges. Though they are meeting their production target or not, the laborers are working. I hope you all got the point. So that's why we have to pay the labor charges. If they can't go for a target, that may be implicit cost, another hidden cost to the company, because they are not producing the expected production. But that production is not the matter. Matter is with the cost. Now hope you all understood. Clear to you all?
Yes, madam.
Okay, thank you. So very good. Please ask this type of question, then others also will get more clarification. Okay. Now we will move to total cost. Now we know fixed cost, variable cost, and the fixed cost. Okay. So fixed cost means, total cost means overall cost of production, which includes both fixed and variable components of the cost. Because apart from that, we discussed about implicit and explicit costs. But I think you all can understand these all variable and fixed cost components also comes under explicit cost, because implicit are hidden costs. Okay, it's not directly involving in the directly we can't see that cost. Okay, so that's why the total cost, we calculate the total fixed cost and the total variable cost components only. So we know the fixed cost. After adding all fixed cost components, we can take the total fixed cost. We know the variable cost. After adding these all variable cost, it comes total variable cost. Then after adding these two, total fixed cost and the total variable cost, we can get the total cost. Is it clear? Hope you all got the point. If not so, please ask again. Now we'll move to the average cost. But you all remember total cost is similar to total production. I mean the terms. Average cost, average production. Okay, so what we have done, average cost means per unit cost of production. Okay, so now in other words, you can see it measures the amount of money that the business has to spend to produce each unit of output. Okay, so average cost is, we can get the average cost by dividing the total cost by the number of units produced. Okay, so easily you can find out the average cost there. Okay, so is the formula. Total cost, number of units. Okay, so here another small example. Now try to get clearly, very carefully read and calculate the average cost. Hope all will answer correctly here. Okay, very good. Hemachandra gave the answer very quickly. We'll see whether it's correct. Others also, please give the answers. Don't ask anybody from your friends, okay? During the examination, you have to do by yourself. Another answer came, we'll see. Ravindu, okay, very good, but we'll see whether it's correct or wrong. Anyway, you're trying your best. Vimandya, another answer, okay. 3 sent 3 answers. We'll see anyway. You need to calculate the average cost, remember. Total fixed cost is given. Total variable cost is given. Yes. Karunaratna, very good. He also has given another answer. Okay. It is interesting. Different students give different answers. We will see. Another answer came Bandara. Okay, very good. We'll see whether your answers are correct, but not a single answer same. That is the case. All are giving different answers. We'll see. Anyway, you are trying your best. Very good. Some are staying idly. Okay. 30 students. Yes, another answer came. I'll see. Okay, Ravindu. Very good. Yes, he is giving somewhat a different answer. Okay. Hemachandra, very good. You also have answered. How about others? New answer came from Koshita. Very good. We'll see the answer. Now Koshita, Kavindu, Hemachandra, Ravindu, Bandara, Karnaratna, and Vimandya gave answers. Okay, we will see others' answers. Okay. Can you explain this question? Okay, another request. Okay, I'll explain the question again. Wait 1 minute. It is difficult for me. Very good. So you frankly saying it's difficult. So please understand the question first. Okay. So total fixed cost is given $100,000. Total variable cost also given $20 per unit. But there are how many units? 20,000 units are there. Then if the cost is $20 per unit, we have to calculate the total variable cost 20 multiplied by 20,000. Now try. Now understood, Hemachandra? Clear the question now. Fixed cost is given, variable cost is given. Yes, this answer is correct. Now you understood well. But now see everybody. Again, check your answers. Yes, Sahasna's answer, another one. Now, 1, 2, 3, 4, 5, 6, 7, 8 students answered. But 8 answers. Huh? Shall we see the answer? Wait. Okay, so these are the information given. Variable cost per unit, it is $20. Sorry, yes, $20, yes. Number of units produced, 20,000. Total fixed cost of production, $100,000. These 3 informations are given. So we are requested to calculate the average cost of production. Okay, see the equation of average cost. Total cost of production should be divided by number of units produced. Now, how to take the total production? Total cost of production. Here, fixed cost is given, variable cost is given. We can calculate the variable cost after multiplying these two. Then what is the total cost? Have you calculated anybody? See, I think everybody's answers were wrong. I think not a single student Please read carefully. Variable cost per unit means you have to multiply it by number of units to see the total variable cost. Have you got this answer? Then it's very easy. Then total fixed cost is already given. Total variable cost we have calculated. Then you have the total cost of production. It should be divided by number of units. Then average cost means $25. Where was the wrong? Nobody gave, I think, 25. Kosita gave 5. Kavindu 100. Hemachandra 7. Ravindu, how it came 140,000? What's the mistake you have done?
It is wrong, madam.
It's wrong, no? Now understood the correct way?
Yes, madam.
Okay, great. Bandara, have you understood the correct way now?
Yes, madam.
Okay. And Karunaratna? Hope now all
Yes, madam.
understood. Okay, very good. Now hope you all understood the correct way of calculating the average cost. Now you will never forget because none of you have given the correct answer. Okay. So see, step by step, it is very clear. You can calculate the average cost. Okay. Okay, great. Anyway, you tried. Okay, so now we will see marginal cost. Okay, now you know variable cost, fixed cost, total cost, average cost. Now we'll come to the marginal cost. Okay, so marginal cost is the change in total production cost that comes from making or producing one additional unit, same as marginal product. You know the concept by learning marginal product, the word marginal. The name you know very well. Okay. So now we will see how to calculate the marginal product. Change in total cost. Sorry, here marginal cost. Okay. Change in total cost. Change in quantity of the units produced. Okay. Instead of product, you have to put cost here. So now try at least to calculate this. Okay. So clearly see the equation first, marginal, because we have learned this concept before. That's why I just gave the equation and the calculation. You have to write change in total cost, change in quantity of units produced. Okay. So a manufacturing company has a current cost of production of 1,000 pens at 100,000. It cost $100,000, and its future output expectation is 2,000 pens. With the future cost of production of this is somewhat difficult, so I will explain and I will teach you how to calculate. Okay. So then please practice. A manufacturing company has a current cost of production of 1,000 pens at 1,000 pens cost is given. Okay. Whatsoever the number, understand first. 1,000 pens cost is given and future output expectation also given. And future cost of production also given. Then they are asking the marginal cost. It's very easy. Okay. So current unit of production is given. Current cost of production is given. Future unit of production is given. Future cost of production is given. Okay. So you have to calculate change in total cost is easily given. Change in quantity is easily given. Divided by these two, you can take the marginal cost. Understood clearly? Though when you're reading wordings, it seems difficult. But when you're calculating, it's very easy. I'll share the PPT with you. Then you can learn by yourself. Every time, do calculation. Even 2 plus 1, 3, just write it. Then you will never forget. Clear in this calculation? Everybody?
Yes, ma'am.
Okay, thank you. Then we will see somewhat theory portion is here. Okay. So production choices in long run and short run. Okay. So you need to remember short run means just short period of time. So short run in microeconomic context is a planning period over which the managers of a firm must consider one or more of their factors of production as fixed in quantity. See, in short run, fixed, no variation. Okay, one or more two factors, maybe land, maybe labor, maybe capital, they keep as fixed in short run. For example, a restaurant may regard its building as a fixed factor over a period of at least next year. It would take at least that much time to find a new building or to expand or reduce the size of its present facility. So in short run, he can do very small operations. Okay. So just because to expand, the reduce, he can expand or he can either reduce the size of the present building. So decisions concerning the operation of the restaurant during the next year must assume the building will remain unchanged. No any change to the building. So other factors of production could be changed during the year, but the size of the building must be regarded as the constant because the building size cannot be changed during short run period. Okay. So with that story, you can understand when the quantity of a factor of production cannot be changed during a particular period, it is called fixed factor of production. For the restaurant, it's a building, it's a fixed factor of production for at least a year, no change. But in long run, they can expand the building, they can reduce the size by making it to several apartments. Okay. So a factor of production whose quantity can be changed during a particular period is called variable factor of production. Okay, this is not variable cost, variable factor of production, fixed factor of production. So production factor keep as fixed, the building. Production factor keeps as variable, changing the size of the building or changing the labor force, okay, or foods. So these are the variable factor components. So in the long run, we imagine, we hypothesize that all factors are changing, all variables are changing. Okay, because in long run we can do many production activities. We can expand the building, we can make it into several apartments, or if we consider this restaurant. Okay, because one example I took to show you what are the implications we can do during short run as well as during long run. Very simple example I took you to explain this, because at any time a firm will be making both short run and long run choices. In short run, they can do keeping all fixed, they can do anything. But in long run, all comes as variations. Okay. So the managers may be planning what to do for the next few weeks and for the next few years. If they consider what to do for next few weeks, it is short run. But if they consider what to do for the next few years, it is long run production process. Okay, that's how managers are taking decisions. Their decisions over the next few weeks are likely to be short run choices. Okay, so decisions that will affect operations over the next few years is long run choices. Okay, so I think the decisions taking short run and long run depends on which type of activities you are planning to do. Okay, so you can take this type of simple example and explain the difference between short run and long run. Okay, so in long run costs occurs. Okay, because change in production levels over time every way. Every way. That's why no fixed factor of production. All are variable. All are varying. Land, labor, capital, entrepreneurship. So these all factors are varying in long run, but short run, all though we are not considering the variable factors and revenues affect short-run production, fixed costs have no impact, even though we keep fixed components, fixed production as fixed, but fixed costs have no impact on short-run cost. Let's say that means, let's say, building or rental charges or any other fixed cost components have no impact. But you need to consider here no fixed factors of production in long run. Factors of production. Okay, here it consider the fixed cost component. So you need to recognize these two separately. So in short run, if we consider short run costs, it doesn't incur fixed cost, but in short run production choices, you have to consider every time their production factors are fixed in short run. Okay, see now long run costs and short run costs are different. Okay, so I here clearly mentioned the differences between short run and long run costs. So the main difference between long run and short run cost is no fixed factors in the long run. There are both fixed and variable factors in the short run. Okay, so these are the main point. These are just clarification of your basic points. Okay, so if we draw the graph, because here I didn't give you data and calculations, because if normally this is the standard way we draw in short run and long run total cost curves. Because short run total cost curves and long run total cost curves, you should remember they touch one time. Okay, so at that time you can see total cost and the quantity is, you can measure the total cost and total quantity. Okay, so this graph shows the relationship between long run and short run cost curves. So these are cost curves. Okay, normally many questions will not ask from this section, just you need to identify the concept only. What is short run cost components, what will happen, how managers will take decisions in short run, and how managers will take decisions in long run, what are the cost components attached in the long run. Okay, so the basic things you can identify under short run and long run. But here, these two things I think you can understand: isocont and isocost. ISO means, what is the meaning of ISO? I explained because isocost curve, isocont curves we have learned already. Iso means anybody out of 31 students? ISO. Hmm? Nobody is having idea. ISO. Same. See, the answer is given here. Produce the same output. ISO means same, quant means quantity. ISO means same, cost means cost. So same cost, same quantity. Now got it? Hello? Hope you all can hear me. Okay. You are messaging. Okay, Mandar, thank you. Okay. Before that also many messages. Okay, thank you. Thank you, Bandar Vimandya. Okay. Mean you understood well ISO cost and ISO quant. Same product, same cost component. Okay. So here also you remember the graph, ISO quant curve. So we explain this. If we use 20 capital and 20 labor, the same production we can take by using 10 capital and let's say 35 labor. Okay, this is isocont curve. Along the curve, quantity is same, though the factors of production is different. Okay, different combination of factors of production gives same level of output, isocont. Okay. So this diagram shows all combination of labor and capital that give total. It has given 4,000, maybe dollar, maybe yuan. Okay, anyway, just understand the concept. Okay, so 20 capital, 18 labor, according to this graph, or 9 capital and 35 labor. 20 capital means more capital intensive, more capital is using. And 35 labor, in second case, more labor is empty. Though more capital intensive, though more labor intensive, these along the curve, they gave the same quantity of production. Okay. So this is ISO cost. Remember, same cost. ISO cost shows all combination of factors that cost the same cost to employ any product. Okay. So that's why here it's given as by euro 40,000, 400,000. If these combinations of this capital and labor gives the same cost along this curve, cost is 400,000. Okay, so it's very easy to explain isocost and isocont curve. Now we'll move to economies of scale. Okay, that is very easy to understand. Economies of scale refer to the cost advantages that business or organization can achieve as it increases the scale of its operations. Have you print t-shirts or something for your function? Last time I heard you celebrated New Year, isn't it?
Yes, madam.
Yes. Then at that time, have you prepared same type of t-shirts or something in bulk? No, different clothes maybe, no?
Yes, different clothes.
Okay. So, but in some functions, you may have heard, instead of ordering 1 or 2 shirts, if we order 100, 200 shirts, we are getting them at lower prices, isn't it? That means,
Yes, madam.
yeah, as a bulk, you can take the per shirt. Let's say we are producing 1,000 t-shirts together. Instead of taking 1 t-shirt, you can take maybe half of the price if you are taking a bulk. Okay. So that's why that is called as simply economies of scale. We increase the sale in order to get lower prices. Okay. So with that understanding, we'll explain different economies of scales: buy in bulk, efficient production, cheaper capital, spread risk, that means sharing the risk, promotional costs, logistics. So these all attached with economies of scale. Okay. So economies of scale may be internal economies of scale. That means highlight the advantages that a company obtained due to use of modern techniques, internal. But external means the external factor. Let's say external road construction. I mean, the road is very nicely constructed, or the surrounding environment is good. So these are the external factors affect the company's future. So in that case, company can take added advantage by using this concept, economies of scale. So there are internal and external economies of scale, as I explained. Internal means internal inside of the business, managerial, maybe financial, maybe technical, marketing. So these are inside the business. But external are information, other resources and other development activities, economies of concentration, because sometimes in the external people's attention is very important to get more and more profits. Okay. So specialization. So these all are external factors. These all are internal factors. You can add many more. Okay. So get the economies of scale. Now we will see how they are getting economies of scale. Okay. So efficient in production, production in promotional cost, sharing the risk, okay, cheaper capital, reduction in the logistic costs like transportation, accommodation and all, or buy in bulk. So these all you can take the economies of scale. While studying the main types of economies of scale, you can understand what are these points. Okay, clearly you can understand there are 4 or 5 types. 1, 2, 3, 4. Yes, 5. 5 types of economies of scale. First, we will see technical economies of scale. Due to specialized techniques, we can take the economies of scale. Let's say, for example, we can any manufacturing company can invest in a high capacity machine that can produce more goods in a shorter time. That result in lower cost per unit. Okay. Similarly, a software company may develop an automated system for testing and debugging codes. So it also reduces the time and effort required for quality assurance. Okay. So in these cases, technical, sophisticated technologies we use to get the economies of scale, reducing cost. Sometimes, in agriculture, we can use tea plucking machine instead of labor. Okay, that is technical economies of scale. So we can reduce the labor cost there if we can hire the machine at lower prices. Okay, so next, purchasing economies of scale. That means purchasing economies of scale arise from ability to negotiate better prices for raw materials. For example, we can say a retailer may be able to negotiate the lower price per unit from a supplier by agreeing to buy larger quantities of a product, as you are doing in buying t-shirts in bulk or your books in bulk. Rather than buying a book, you can take book at a cheaper price if you are buying as a bulk. Okay, so manufacturer may be able to negotiate better price for raw material by purchasing them in a bulk. Okay, even vegetables, fruits, this all you can take at lower prices when you are purchasing as a bulk. Okay, another type, financial economies of scale. That means ability to borrow money at lower interest rates due to large size of the organization. So interest rate also highly affect the financial status. So if any company can borrow money at lower interest rates, the retaining they can save as a special gain. So that is called as economies of scale from the financial point of view. Okay. Then marketing point of view, if any company is ability to spread advertising and marketing cost over a large, that means if they can do advertising at lower costs, okay, then at that time they can gain the economies of scale. For example, a company that produces a high volume of goods may be able to advertise more effectively by using mass media such as television or radio rather than advertising just one or two products. Okay. Similarly, a company that operates in multiple regions or countries may be able to spread its marketing cost over larger customer base. Okay. So instead of advertising a particular product, if they advertise as a quantity, as a bulk, so same cost incurred, but for the highest production volume. In the region wise also, if let's say a radio advertisement or television, so this will reach different areas, different countries within 1 second. Okay, then instead of going door to door marketing, door to door selling, they can take quick attention from the consumers. Okay, then they are getting marketing economies of scale in these. Then finally, the managerial economies of scale. So from the managerial point of view, the efficient managers are able to reduce the cost by using different techniques. For example, a company may be able to hire more specialized managers or consultants as it grows, allowing it to improve efficiency and reduce costs. Because if efficient managers are recruiting, they know everything, how to take the products at lower prices, how to reduce the total costs of a company, okay, how to improve the efficiency while reducing cost. So everything they know. So the cost they use to hire is more profitable than using unprofitable techniques because it may increase the cost. Okay. Similarly, a company may be able to centralize its management function. Then, many people are in the managing process. One manager, because centralized means all line, let's say networking. Okay, all line connected to each other. So it's very easy to monitor the people and get the thing at lower prices. Okay, in company also. If they need the production, so they can order very quickly. The managerial talents. Okay, central, the ownership is centralized. Okay, so I think these 5 components, these theories, you can understand clearly. Economies of scale, technical, purchasing, financial, marketing, and managerial. Okay, but not only economies of scale, there are diseconomies of scale as well. Okay, so diseconomies occurs where cost per unit increases. Okay, till cost per unit decreases, the company gains economies of scale by using technical know-how, by using purchasing economies of scale, or by using any types of economies of scale we discussed here, managerial, marketing, financial, purchasing, or technical. They can increase the economies of scale, but if this economies of scale occurs when the cost per unit increases, cost is increasing. That means no economies of scale. That means diseconomies of scale. So it takes place when economies of scale no longer function for a firm. Cost is increasing means it is not good for the firm. So with this principle, rather than experiencing continued decrease in cost and increasing output, a firm sees an increase in cost when output is increasing. Okay, so what they can do, this economies of scale with the expansion of output comes with increasing average cost. Now output is increasing, but the cost also increasing. But economies of scale means output should be increased while decreasing the cost. Okay, so diseconomies of scale can involve factors internal to an operation or external condition beyond the firm's control. That means sometimes diseconomies of scale may happen due to internal factors. Let's say huge, management disorder or financial problems, or internal. Also external conditions due to other companies' attention or the destroyment of some other external businesses. Okay, so these type of external conditions or internal conditions inside the business can, because external conditions beyond the firm's control, sometimes sudden flood, sudden disaster, that also external conditions. Okay, so diseconomies of scale, their cost is gradually increasing. Okay, so diseconomies may result due to technical issues in the production process, maybe organizational and management issues or resource constraints. Okay, so these all you can clearly understand. So if I'm asking to draw you economies of scale and diseconomies of scale, it is clear for you if you draw the line with the average cost and output. You know, if our firm is getting economies of scale, our average cost, that means change in total cost, change in units produced. So per unit production is gradually decreasing. But when time comes, per unit product cost is gradually increasing. That is diseconomies of scale. So we have to identify that break-even output. So after that, producers should not produce because they are producing diseconomies of scale. Okay? So in mathematical point of view, we can say if my average cost is higher than the marginal cost, that is economies of scale. Okay, because average cost per unit cost is more, but marginal cost is still low. That means change here you may remember the marginal cost. Okay, so marginal cost, because if I don't have the blackboard, see marginal cost, change in total cost and change in quantity. So still that is low till the time it remains lower. That means companies getting more and more economies of scale. But when it gets more, that is very dangerous because additional input or producing additional unit gets more price than its average cost. So it is this economies of scale. So after calculating marginal cost and average cost components, let's say my first question, calculate average cost and calculate marginal cost. Then decide whether it is under economies of scale or under diseconomies of scale. So based on the answers, you can decide whether the marginal cost is more, it is diseconomy. If marginal cost is low, if more marginal cost, diseconomies. If less marginal cost, it is economies of scale. Okay. With this also you can see the diagrams. Normally marginal cost can relate with the marginal product. Average cost can relate with the average product. Where the marginal, because see, cost components are reducing till it decrease, product is increase. Okay, when these two touches together, see, from that point, cost is increasing due to that average product and marginal product also decreasing. Okay, so at that time, up to here, economies of scale, but after that, diseconomies of scale. Okay, I think you can identify after carefully observing these diagrams as well. Okay, so we can see the relationship between returns to scale and economic of scale. I think you can recall the production function. With the calculation, we divided 3 areas. Increase in returns to scale, decrease in returns to scale, constant returns to scale. Do you remember? Again, I didn't draw the production function. Hope you all remember these 3 the 3 stages of the production function. So in these 3 stages, we can compare the cost function. So increase in returns means economies of scale. Decrease in returns means diseconomies of scale. So constant may be neither economic nor diseconomic. Constant. Okay. So next last section we'll do applications. Under that, income inequality and poverty, international trade briefly, because from the things you learned so far, we can just discuss income inequality and poverty, international trade, and behavioral economics briefly. Next 4 hours. Then we'll do Thursday night. Is it okay? Hello?
Okay, madam.
Okay. So hope today we discussed about main cost components before we study about the production and production curve and all. Okay. So here basic cost components we discussed, opportunity cost, implicit, explicit cost, and variable and fixed cost components, then total cost. Then we discussed about the average cost and marginal costs. Then we discussed about the long run and short run in brief, just to make you clear about what is short and what is long. Then afterwards, isocont and isocost we discussed. Okay, so isocont same quantity, isocost same cost. Okay, so economies of scale we discuss about many factors, internal and external economies of scale, internal factors and external factors. Okay, then types of economic scale, technical, purchasing, financial, marketing, and managerial. Then diseconomies of scale we discussed, and we compare diseconomies of scale with the cost function. So, sorry, production function and cost function, just to explain economies and diseconomies of scale. Okay. Any questions? Hope you understood. Still 30 students are there. So please read. I hope you got, because maybe for the first time you are not getting fully 100% understanding, but please read and come next day. Okay, I mean Thursday. Before that, if you need to clarify something from today's lecture, we can discuss. Though it's nearly 10. Any questions?
No, madam. But if you can share the PPTs quickly, we can read them.
It's echoing. I'm not clear. What you told, just to share the PPTs.
Yes, madam. Yes, madam.
Okay, sure. I'll just share now. 13 and 12. 12 we have done last week. 13 is this one. And other PPTs I hope you found.
Yes, madam.
Yeah, okay. I'll try my best to find that recording, because you heard that 18 some students, many students absent. So I'll just find the recording, maybe the problem. But anyway, I'll try my best to find that, and I'll share that one as well. If not so, before the exam also, I can just explain the thing. Don't worry. Okay, if you have any problem, we can have a revision class even after combining these all sections. Okay?
Okay, madam.
Okay, if time permits, we will do this also. And all the best for your preparation and exams. And please read and come all sectors, all sections I have done, because next section is our last section. Okay, before the exam. So if you have any questions, clarifications, calculations, please come, and I'll give you some time to ask questions and clarify your things. Okay, then. Thank you.
Madam, excuse me.
Yes.
Madam, in that exam structure, there is 5 marks for a Viva, madam.
Yes, Viva. No, that day, is it okay that day I explained the situation wrong or correct?
Madam, you didn't mention about the Viva. Will it be held, madam?
No, I mentioned about Viva. I gave you Viva was total time allocated 15 minutes per student, and marks allocation is 5.
Yes, madam.
Yeah, yesterday in my please check my very first PPT.
Yes, madam. That means after the paper, will you have to face that Viva exam?
Yes, as far as I know, you can talk to your coordinator as well. As far as I know, you are after finishing your exams. Let's say part 1 is MCQ and part 2 is essay. So after finishing these 2 papers, you have to face the Viva examination.
Okay, madam. Thank you.
Okay. All the best for the exam, and read all carefully and prepare short notes. Okay. So many things I am giving just for your background knowledge also, but take the main points and understand everything clearly. Then I think you all can score very well during the exam. Okay, then we'll meet Thursday 8 to 10. 6 to 10. Okay, good night.
Okay, madam. Thank you. Good night.
Okay, good night.